What we have in front of us today is an article from Schwab. Let's see, I think this is Schwab. No, this is www.nasdaq.com. Precious gold drops to lowest in nearly 4 months as higher U.S. yields fuel risk appetite. There's an important story here that some of you that are new to silver stacking may want to get acquainted with, and the pros definitely know this, but interest rates do affect precious metals. Okay, that's why you should keep track of interest rates and develop an opinion whether or not you think they're going up or down or staying the same. This article is dated July 10th and 2017 by Reuters, and I'll go through it really quickly. Gold slid to its lowest in nearly 4 months on Monday after the latest U.S. jobs data boosted stock markets and Treasury yields, crippling demand for safe haven bullion 3%. The fall in gold prices is very much underpinned by yield-chasing behavior, said OCBC analyst Barnabas Gann. Higher yields on assets such as U.S. Treasuries increase the opportunity cost of holding non-yielding bullion. There are no dividends on bullion. If Treasury yields in the U.S. and Europe move higher, that will most likely cap any gains in gold and will test the downside again, said Jeffrey Haley, senior market analyst at Owanda. The 10-year U.S. Treasury yield hit a 2-month high of 2.398% on Friday. Data on Friday showed U.S. non-farm payrolls jumped by 222,000 jobs last month, beating expectations of a $179,000 gain. The dollar steadied and Asian equities remained supported by Friday's data. A stronger dollar makes gold more expensive for buyers outside of the United States. The market also awaited U.S. Federal Reserve Janet Yellen's testimony on Thursday, which could provide further hints on the central bank's stance on interest rates. Analysis. Holdings at the Spider Gold Trust, GLD, the world's largest gold-backed exchange-traded fund, fell 0.63%. Hedge funds and money managers in the week of July 3 reduced their net long positions in COMEX gold and silver for a fourth straight week, U.S. Commodity Futures Trading Commission data showed on Friday. Among other precious metals, silver fell about 2% to $15.27 per ounce. In the previous session, it touched $14.86 an ounce, its lowest in 15 months, in what appeared to have been driven by an accidental order, yeah, right, according to U.S. traders. Palladium declined 0.3%, platinum dropped 0.5%. All right, so I think what's interesting here to people that aren't really intimate with the stock market and the bond market is the relationship between gold, silver, and interest rates. All right, and what I'm going to do, I'm going to pull up a chart to try to talk about this a little further for those of you that are interested. Thank you, guys. So it is today is July 10th, early morning, but this chart ends on July 7th. This is a chart of the SLV, that is the silver ETF, which trades a little lower than the actual metal. But you will notice over the last 3 years it has been channeling between roughly 14 and 20, and here we are today closer to 15. What I'm going to do is I'm going to add another symbol to this chart to show you the relationship between 10-year bond yields, U.S. bond yields, and the price of silver so you can see what's happening. So over in my add comparisons, I'm going to add the TNX, which is the yield on the 10-year bond, and you'll see an overlay now of yields. Oopsie. You'll see an overlay of yields versus silver. Silver being down here in the blue, 20 down to 15. Okay, and it was back up at 20 back in 2014 as well. And then the yellow, which is the yield on the 10-year U.S. bond. So when the article talks about interest rates going up, that's the orange or yellow line, pushing metals down, what people are doing is they're saying the opportunity cost to hold precious metals, which bear no dividend, becomes too high, and they jump over to U.S. bonds. And what's happening here is, as we got a new president late last year, and that drove interest rates up because people were more optimistic about the economy. And then over time, interest rates began to fall back because people were skeptical that some of the things that were promised would happen. And now the economy seems to be improving a little bit with a better jobs report, and rates spike up again. Okay, up to 2.3, 2.35, something like that on the 10-year. Still very low historically. So that is what's pushing down the metals today, and that is why you want to keep an eye on the Federal Reserve, and you want to judge for yourself if you think interest rates are headed higher, much higher, back to the old days, or if you think that we are kind of at a top in interest rates and therefore precious metals have reached close to their bottom. And I think they probably have a little ways to fall here, and I think rates could inch up a little bit. But it's also interesting to note that these rates are very much confined. The Federal Reserve does not have a lot of power to jack rates high, because if they raise them too high, then we literally cannot cover the debt service on our national debt. So there's a natural barrier to increasing these rates further. And then others might note that the economy is not as strong as some people think it is. The jobs reports are often released and then revised downward at a later point in time. There are lots of reasons to not really believe that interest rates will stay at this level or go higher. But if you were to expand this period to 5 years, you would see that rates were much higher if you were. All right, the lady you're looking at here is the head of the Federal Reserve. Her name is Janet Yellen. The Federal Reserve has two mandates: price stability, so to control inflation, although 2% is their target, believe it or not, 2% every year. That is 100% over 50 years. And their second is full employment. So her goal is to keep the dollar, keep the dollar inflation from rocketing out of control back to Jimmy Carter era levels, so that the wheels don't fall off the bus. Her second objective is to promote a healthy economy and have full employment. All right, and her tools for doing that are interest rates, and she can raise them and lower them according to the votes of a committee that she's part of. Now, this guy, though, our new president, his goal is also full employment. Clearly, he would like more people to go back to work. And price stability, I think, is, I think he is concerned about the deficit, but he is making some very inflationary moves in terms of spending and tax cuts. And it's not looking like he is going to be much of a fiscal conservative. He looks like he's going to be growing, trying to grow the economy with massive spending and tax cuts. So I think these two are at odds with each other just naturally. And while no one wants high inflation, everybody does want full employment. And this is the battle. So I think we need to continue to watch the success of Donald Trump in terms of reinvigorating the economy. I think we need to watch the reactions of Janet Yellen, although, as I said, her tools are very limited in order to fight potential inflation. And people do not see inflation. Of course, precious metals perform well in an inflationary environment. And so luckily, there has not been any inflation to fight. However, if the wheels come off the bus and the value of the dollar starts to decline due to massive printing, more quantitative easing, or just other poor fiscal decisions, then higher interest rates could be required. However, I do believe it would be very, very difficult for them to raise interest rates much further than they are because of the national debt. So keep all those things in mind when you're judging whether or not you want to own precious metals. Are they an investment for you? Are they an insurance policy? Are they a transfer of generational wealth? Really, your goal is really important when you consider how much money you should tie up in the metals. Should you own silver? How much silver or gold should you own? Will interest rates be a formidable, foe for the precious metal? Those are good questions to ask. For me, it continues to be an insurance policy, a hedge, a way to transfer wealth generationally, a way to prepare for retirement for a portion of my assets. I personally don't see interest rates going back to the moon. However, you never know. I don't see the monetary policy really becoming prudent anytime soon. I think we have Democrats and Republicans that are anxious to spend us into oblivion. So, there could come a point where this metal becomes a really valuable part of your asset. So I would not lose faith in it, but I would watch the indicators, watch those interest rates, watch Trump, watch Yellen, and you'll get a feeling for what is going on in the world. Okay, you guys, I hope that you found this interesting.